Step 3, execute advanced tax strategies. Once you've diversified your equity and investments, it's time to layer in advanced tax strategies that can truly move the needle on your lifetime tax bill, often by hundreds of thousands or even millions of dollars. One of the most powerful tools in our toolkit is the Qualified Small Business Stock Exclusion, commonly known as QSBS. Under Section 1202 of the Tax Code, if you acquire shares directly from a U.S. C corporation and hold it for at least 5 years, or 3 years under recent legislation, you can exclude up to 100% of the capital gain on those shares. That exclusion applies to the greater of $10 million of gain, or 10 times your original basis. This exclusion was increased to $15 million in the latest legislation. In practical terms, that can turn a multi-million-dollar tax liability into zero. To qualify for the QSBS exclusion, the issuing company must meet several criteria. It needs to be a domestic C corporation with less than $75 million in assets at the time of your purchase, and at least 80% of its assets must be used in active business operations rather than held passively. You must acquire the stock directly from the company, either for cash, property, or services, and hold on to it long enough for the exclusion to vest. Recent law changes have shortened the required holding period and increased both the asset size threshold and the exclusion cap, making QSBS more accessible than ever. Consider the experience of one of our clients who invested $1.2 million into his own early-stage startup. 5 years later, his shares had grown to $10 million. Without QSBS, he would have faced roughly $3.3 million in federal capital gains tax. We helped him prepare carefully for this exemption by verifying the company's eligibility, documenting his direct purchase, and making sure the company was compliant with the QSBS requirement. He was able to exclude the entire gain. The $3.3 million he saved went straight back into new ventures, fueling his next chapter. Another advanced strategy we implement for clients who get equity grants is the Section 83B election, which often feels counterintuitive at first, but can produce dramatic long-term savings. Normally, restricted shares are taxed as ordinary income when they vest, potentially at very high rates. By filing an 83B election within 30 days of grant, you instead elect to recognize that income at the grant date, often when the stock's fair market value is negligible. From that point on, any future appreciation is taxed at the more favorable capital gains rate. Imagine planting an acorn and paying a small planting fee up front, rather than paying a much larger fee when the oak tree finally bears 1,000 acorns decades later. That small planting fee is your 83B tax hit, and the future acorn harvest is taxed as capital gain, not ordinary income. One of our entrepreneur clients filed an 83B on 200,000 restricted shares valued at 0.05 each, recognizing only $10,000 of income in that first year. When his company later sold for $50 per share, the resulting $999 million gain enjoyed long-term capital gains treatment instead of being taxed as ordinary income, saving him well over $2 million. Finally, it's worth noting that setting up certain types of trusts can multiply your effective QSBS exclusion. By establishing multiple trusts, each eligible to claim its own QSBS benefit, you can expand the total amount of gain sheltered from tax. We work with specialized estate planning partners to structure these vehicles so they align seamlessly with your overall strategy. But the key takeaway is that trusts can amplify the benefits of QSBS when your estate plan calls for it. In our experience, clients who integrate QSBS planning and 83B elections into their broader financial playbook often see their tax savings projections grow from 6 figures to 7 figures. These advanced techniques transform a traditional wealth plan into a dynamic, tax-optimized roadmap that accelerates your path to lasting financial independence.